In this video, we're going to talk about NIO, trading under the ticker symbol NIO. NIO is a Chinese EV manufacturer operating mostly in Asia and considering expanding in other markets as well. The main appeal of NIO is that for a fairly long period of time, its stock managed to mimic the stock price pattern of Tesla back in 2020, and that many in the industry view NIO as a potential rival to Tesla or a viable alternative to one of the most valuable companies in the world if investors wish to participate in this promising sector. Another appeal of the company is that it is operating out of one of the most valuable markets around the world and one with the most future potentials as far as the EV sales are concerned. With the upsides also come along the risks. NIO stock is traded in the US but doesn't have the bulk of its operations within the SEC's purview. The trading volume of NIO has recently been 24 million shares compared to an average volume of 52 million shares. Over the previous 52-week period, its price has been fluctuating between $27.52 and $66.99. The market cap of NIO is currently at $45 billion, compared to an enterprise value of $52 billion. The difference between the market cap and its enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact the profitability, attractivity, and solvency of the company. Another key element to understand here is that the asset composition of many companies, and especially for tech or growth type startups, is that one of the most significant assets that they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than other companies, especially because they may have a good management, stronger brand recognition, or bigger online following, and so on. I would say that the bigger online following is especially important for stocks. I'm not sure if that applies to all the companies regarding their fundamentals, but it's kind of important for companies to have an online following if they expect to be popular with retail traders. In other words, goodwill is not a tangible asset that companies can use to generate more income, but it's often the reason why some companies may be perceived to be traded at a discount, because the market cap is lower than the enterprise value, even if the market value includes the goodwill. In comparison to its historical price fluctuations, the stock is 1.5% higher than the 1-month low, 1.5% higher than the 3-month low, and the 1.5% higher than its 52-week low. In terms of the options market, which often gives a hint on a market sentiment on where the stock price is likely going to head toward, the implied volatility is 70.5% compared to a historical volatility of 76.4%. The put-call options volume ratio is currently at 0.56. The most recent volume of options traded has been 235,000 contracts within a day, compared to the 30-day average volume of 259,000. In terms of open interest, the most recent volume of open interest has been 2.1 million contracts, compared to the 30-day average of 2.5 million contracts. Regarding the shareholder structure, institutional shareholders currently hold 33.5% of its outstanding shares. The biggest shareholders include BlackRock, Vanguard, and State Street. The relevance of the shareholder structure is important to determine if you should be holding the stock long-term or to view it as a short-term volatility play. The stock is mainly held by retail traders. If that's the case, well, it is the case with NIO, then it may be a sign that the stock may lack the depth to justify long-term holdings. But of course, in the case of NIO, institutional shareholders hold close to 35% of the total equity. And that is actually a good thing. So it does justify that, maybe you can consider holding NIO, at least for part of the allocation for long term. Because even if there are a lot of exceptions, of this assertion, usually the consensus is that at least 25 to 30% of institutional participation should be for it to be considered as a sound investment in the long term. Let's also look at the short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what has been going on with GameStop and AMC. The current short interest is 4.02% of the total float and 45.4% of the dark pool transactions. Now, let's take a look at the indicators as well. Financial indicators give us a suggestion of if the stock is overpriced, like oversold or overbought, and they can be used as one of the elements to determine what should be our overall approach. Overall, the oscillators are showing a tendency of being neutral, with 1 sell, 9 neutrals, and 1 buy. The moving averages of the past price action suggest a tendency of strong sell, with 14 sell, 1 neutral, and 0 buy. The moving average can be used to determine if the stock is overbought or oversold. In terms of pivot points, which are levels of support and resistance sprinkled in the price patterns, the support levels are $13.56, $25.12, and $28.26. For the resistance levels, they are $33.90, $34.12, and $46.65. I think that what comes down to my assessment about NIO over time is that it is representative of the great run many EV believers had back in 2020 and that many tried to recreate in 2021, which to some degrees it succeeded. We're now in 2022, and I believe that we need to look at the company with new perspectives. On one hand, NIO is still having excellent fundamental results and is now advancing on its plans to expand overseas in both Europe and North Americas. Job postings recently released by the company are heavily suggesting that NIO will be expanding in North America. Whether this is just for show or actual job postings remains to be seen. But so far, we don't have any reason to suspect that these jobs are just for show, so we're going to assume that they're for real. In other words, as far as the company is concerned, fundamentally things are going well. On the flip side of the coin, I think that a very significant factor of the stock performance will depend on the overall market sentiment and the mood investors will have towards the EV sector at large. Some of the price movements that we've been seeing with NIO is caused by the hesitation of investors, especially considering that many of these companies are valued at multi-billion dollars. Their sales are about a fraction of what traditional manufacturers manage to sell. But so far, it didn't stop them from getting those amazing valuations. And in a way, the market is pricing in their supposed potentials as a fact. It doesn't mean, however, that the market will always be comfortable with those valuations. Actually, when we look at those events influencing those companies' stocks, it's pretty obvious that what matters to them are very similar to what matters to traditional auto manufacturers. We can say that there's a bigger technological aspect to it, but it doesn't necessarily make all of them tech companies. And even if they were tech companies, there have been questions about their valuations, right? Just look at Palantir. Going forward, I think that many investors will start to feel this and wonder whether electric vehicle manufacturers should really be valued at their current price. Another thing that we have to consider is that the sector is getting more crowded as we move forward because existing companies are now competing by rolling out new models, and there are also new ones getting introduced to the stock market. We just have to look at Rivian recently. Even if the stock price isn't doing that well at the moment, what I mean by this is that if the market cap is very high, it means that there's money in this company. But the money may come out of other companies to be put in Rivian. So some of that money may be put out from NIO. That's what I'm trying to say. One final factor to consider is the actual health of global economies, something that we really ignored back in 2020, after March of 2020, and that we've tried to ignore in 2021. I'm not sure if we can keep a blind eye on this in 2022 because there have been red flags over the years, but recently some of those indicators became real life facts regarding the potential negative growth of the economy, both in Asia and outside of it. So, all those elements do suggest that 2022 may be an interesting year as far as volatility is concerned. My recommendation is to remain overall bullish about NEO, but to always keep in mind that those factors will exist and we should control both our maximum exposure and to minimize the entry point. Regarding the strategy to adopt right now, I would say that the timing isn't right to enter the stock because the equity is clearly being reevaluated by the market participants. I would suggest to maintain a maximum exposure in NEO at 5% of your portfolio, but if you have a normal risk appetite, I would say to limit it at 3%. And to enter in the trade only when there are more support found. The correction is still underway, so this is why I would prefer to wait for another few trading sessions or even weeks to see if the market is more willing to get in. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks been shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small, so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.